Good afternoon, everyone. Welcome to another one of our Wednesday market reviews. We're going to do what we normally do on Wednesdays. We're going to cover the four major markets. We're going to take a look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we conclude that, we'll take a quick look at the U.S. dollar, see how it's doing, see how it's affecting gold, silver, and oil, and then we'll move on to chart requests. If anyone in here has a chart request, feel free to type it into the chat, and I'll be more than happy to take a look at it when we get to that portion of today's stream. Welcome, Ray. Good to see you in here. Hopefully we have a few others that come in as we start moving forward. If you like what you see here, or you like this recording, and you like the analysis that I'm doing on the markets, you can follow me at StockDarts on Twitter. You could find these videos on YouTube at StockDarts as well, or you can visit me at patreon.com/StockDarts, where I post weekly blog content, typically posting trade ideas or watch list additions that I put in, and what I'm looking for as far as when they'll be ready to trade. Other than that, let's go ahead and start it. The first thing we'll go do is take a look at the S&P 500. So let's go ahead and get to our charts. Hope you're having a good week, Ray. I think those names we looked at last week, I think they're doing all right, right? So hopefully you're having a good week. Welcome those of you that are starting to filter in a bit. Hopefully, like I said, hopefully everyone's having a good week, and the market's been doing pretty well. We'll get to it in a second. I had an earnings trade on Lyft yesterday, and it's right at the edge of profitability. It's profitable right now, but not really, as you can see, right at the edge of my expected move. So I'm probably looking to close that trade unless I get a nice bounce into the afternoon. All right, Ray, we'll take a look at those when we get to the chart requests. All right, so here's a look at the S&P 500. And as we can see, we're up pretty strongly from last week. Those of you that remember last week when we were looking at the markets, we were expecting a sideways consolidation, possibly down a little bit, and then from there, an attempt at resuming, an attempt at a resumption of new highs. And so far, that's what we got. We had a nice little bull flag, a 3 or 4 day sideways consolidation at the highs, and then this week we've started off with a strong run on Monday, Tuesday, and Wednesday. As you can see, all 3 days have been pretty strong. Despite the fact that they have all been nice days to the upside, I think we're seeing signs of selling pressure as of today and yesterday. As you can see, the candles are getting smaller and smaller. We're going to zoom in a little bit. And yesterday we actually did have a spinning top, and then today we have, again, sort of a little hammer at the top, which is typically not that bullish. I wouldn't call them bearish, though, because the market is, when we have a market as strong as this, a lot of times we just kind of slowly inch forward. But what you can see here is we're starting to do the same thing that we did at the end of last year and beginning of this year, which is we're starting to form another ascending wedge. Let's fix the trend lines here. So as you can see, we've got the same price action going on as before, which again is showing us that the buyers are really pushing it to the bears. The buyers are really sticking it to the sellers right now. There's very little selling impact in the market, and it's basically a mirror image of what we already saw earlier this year. And typically the way these things resolve is you just kind of drift upwards, and eventually you have enough selling pressure where you get these kind of quick drops. And the last time we had that scenario, I pointed out that when you get these quick drops, they're not necessarily tops to a market. They're more along the lines of you have to get these quick price corrections in order to shake out a lot of the weaker hands that keep chasing the price action higher. And then you find that the more patient buyers are the ones that step in and buy it once we get to support levels that are healthier or more value oriented, as opposed to the traders that are chasing the price action higher. Now, the other thing I want to point out is these types of behaviors or these types of price patterns, they can persist for a lot longer than you would expect. So if you take a look at this wedge that started back in December, it lasted about two months. And if you really think about it, it looked like it was just going to be, the wedge was something like this, right? And then you had the quick little drop, and then eventually it just turned into an even larger wedge. And then finally we had the pullback, and then now we're starting again another pattern very similar to that. And I suspect that from here to next week we will eventually reach the top of this wedge, because you can see this one's a little bit more vertical, a little bit more I think short-term in nature. And once we do get that drop, we're likely to come back and test the 20 and probably try to shoot through it and maybe make our way back to the 50. Um, we have the beginnings. Now this is, of course, this is pretty hypothetical, and I don't want to really I don't really want to scare anybody yet, but we do have the beginnings of what could end up becoming sort of a head and shoulders. As you can see, we've got a move up and then a pull back to our neckline around 320, and now we've got a move to try to exceed that high. Now, if we do slice all the way back to the 50 and come back and test 320, then that's going to set up a potential scenario where the next attempt at a move higher could end up falling short and then we'd come down. That's a long way to go, and that's not something that I really want to push too hard right now, but I do want to point out that we're starting to see the signs of what could be too much supply for us to push through around this 330, 335, 340 level. Now, it could not it might not play that way at all. It might play out completely differently. It could be that we pull back and test the moving averages and then continue forming new higher highs as we push forward. And I think a lot of that will depend on what we see across the board with all four of the major indices rather than just the S&P 500. But I do want to point out that what I'm seeing here, I'm beginning to see signs of selling pressure, despite the fact that we're just kind of ignoring the sellers as we kind of climb higher. These price patterns aren't really the way that I like to see the price action move. But for now, that's just that's something that could be in the future, could be something I'll keep an eye on. But as far as what we're looking at in the short term, I think that we're in a very strong market, and it continues to really surprise. Not that it climbs higher. I'm expecting it to climb higher, but it continues to surprise in the fact that it doesn't pause long enough for enough charts to reset or for the sellers to gain any kind of a foothold and let buyers come back and buy at value. We had a move down here to value, and it lasted only really a couple of days before we shot right back up, and we started the same sort of overbought conditions that we had prior to that. And so we have really just buyers that are completely starting to take over the price action in the market. And a lot of times, that sounds positive, but a lot of times that's a negative because you start to get these imbalances and you don't get the healthy ebb and flow that you would get in a normal market. Typically, you just like to climb forward, pull back, climb forward, pull back, climb forward, pull back. And these situations, I don't think we're getting pullbacks with enough regularity. But like I said, right now the bulls are in control, and really the issue is, as I mentioned in my Patreon page this week on Monday and on Tuesday, it's not looking for long scenarios, it's looking for better risk reward scenarios. And the problem is when we get these wedges, these rising wedges, a lot of times the market is following that, and you're getting price action that's overextended, and it's not giving you good risk reward scenarios, and you're not getting the right kind of consolidation patterns. Typically, when I'm looking at trade, when I want a high probability setup, the type of consolidation pattern you want is you want narrowing volatility, which we're getting, but you want it coming down into support like this, right? So that way you get a good stop point with very low risk, and you get a nice reward with a lot of potential upside. What we're getting is the opposite. We're getting the price action is contracting, but it's going up, and what that ends up giving you is very little reward and a lot of risk, as your stops are way down here and your potential reward is basically up where you're already at. So we're not really getting the right price action to get a good risk reward and good high probability setups. And because of that, despite the fact that the market's going up, I've found trading opportunities to be a little bit more sparse than I expected. And so hopefully we get another pullback, and it's not the head and shoulders. It's just a pullback into maybe the 20-period moving average, and we kind of consolidate for another day or two, and then maybe make our way back up and continue stair-stepping upwards. And we'll see if that maybe changes things. Now, that being said, there are always going to be pockets of strength in the market, and when you have a market like this where the market itself is not giving you good risk reward, and you have a lot of stocks that are mimicking it, what you have to do is just be a little bit more diligent and dig a little deeper and look for areas of the market that are giving you the better risk reward scenarios. And you got to look for names that are either finding good value or giving you good consolidation ranges that let you manufacture a risk setup by just looking for short-term support levels that if they get breached, the chances are pretty high that it's going to turn around and go lower than that. So, things like bull flags or pennants, where that if it fails the bull flag, even though support's underneath it, that you could stop out there because there's probably going to be a bit more of a prolonged correction if it does indeed fall below the bull flag. Now, if we look at potential levels on the S&P 500, I think again we've kind of already gone through them, but we basically have 320 as a critical support level, and then after that we really just have the moving averages. This level here around 332 will be the next short-term level of support, and it will likely coincide with the 20. And if we want a market to continue stair-stepping upwards, what we want right now is we want to pull back into the 20, we want it to drift sideways, and then we want it to kind of hold at this 330 and then print new highs again. And if that's the case, then it could be that we're just forming a longer-term channel and that things are okay, and that we're not really, these rising wedges are just part of what is in reality a longer-term, nice, smooth channel that keeps going upwards. And there's very strong potential for this, so I'm not really that concerned yet about the head and shoulders. I just wanted to point out that that is a potential scenario. But another potential scenario, one that is hopefully a little bit more likely, is that we do pull back, but when we pull back, we find support. And again, this bottom trend line is pretty theoretical. There's not a lot of support here. I'm not connecting too many candles. What I'm doing is just giving you the general slope of the price action that we've seen since last October and November. And if we kind of continue fleshing this out, we could eventually develop a more coherent bottom of that channel that we could trust a little bit more because we'll have more data points connecting them. But at the moment, that's not where we stand. But there is a very strong potential that we continue to climb upwards in that sort of a channel. And if that's the case, well, then we will just continue moving upwards in the market. And I think that a key to that will be some of the weaker areas of the market starting to get a little bit more healthy and participating a little bit more strongly. And giving us more opportunities for us to chase risk and not worry too much about rewards. So in other words, we need traders to be more aggressive and a little bit less fearful than what we're seeing right now. Now, there's not really a resistance level I could point out because, again, we're at all-time highs. We printed new all-time highs again today as we did yesterday, as we did the day before. So really, resistance is where we're at just because it's the highest we've been. And like I said, if you kind of extend the top of this channel, we're kind of right at it again. So there's a good chance that we are reaching kind of the top of our current move, and we're probably going to need to pull back. And the same as last week and the week before that, I think it's the nature of that pullback that's going to dictate how we want to go ahead and keep trading this market. But overall, we're still in a very strong market. And despite the fact that if you look at it in the long term, we are getting pretty overextended, and there is potential for a pullback, I think overall the market is still in a very strong state. And until we see a change, we just need to continue following it upwards and keep taking advantage of this price action. One thing I want to point out, for those of you, maybe there's a couple new people in here, if you look at what the market's done over the last decade, basically, we've had periods of sideways consolidation followed by long stretches of a market climbing upwards, right? We had a very nice, long, steady channel from 2012 to about 2015. You can see this channel here lasted basically 2 years, and that really I could extend it and start it maybe way down here in 2011. And then we had about a 2.5-year correction. And then after that correction, we again had a market that stayed in a very steady upslope for at least a year, almost a year and a half, right? And then we had another 1.5 to 2 year correction, and now we've started to climb upwards. And so despite the fact that the market seems stretched down and looks like we can't really go much further, if you look at what we've done the last 2 times that we had these nice 2.5-year bases, there is potential for us to keep climbing this way, possibly even all the way to the end of the year. I don't think that we're in quite the same scenario, and from what I'm seeing so far, I don't think we're going to have a year-long rally like I was kind of hoping at the end of last year. But I do want to point out that there is still potential for us to continue climbing upwards and mimic one of these 2 patterns that we've already seen play out twice over the last 10 years, and there's a possibility that we do it again for a 3rd time this year. So that being said, the reason I'm pointing this out again is not to get you too excited and to have you ignore all your stops and just hold everything long, but just to keep in mind that you should not try to short this market or get scared just because the market's at highs. If the market is going to roll over, if we're going to get a top, if we're going to have a correction, we will get warning signs. We'll see maybe that head and shoulders form, and that would be a good warning signal that maybe there's more room to the downside. We'll see us start to slice through these levels of support, and that'll give us clues to start to maybe move more to cash or to start putting in our stops. and we'll start maybe breaching some lower levels of support. As you just saw in the long-term chart, we've got a long way to go and still really have a breakout that's intact. If we came all the way back down to 300 on the S&P 500 or on the SPY and then bounced, well, we still really broke out from the range that we were spent the last couple of years in, and we're still technically in a market that is breaking out and establishing new highs. It just came back and retested that breakout. So there's a lot of room before we have to worry about a market that's turning into a bear market or even more of a real strong correction in a market. So until that happens, until we get enough warning signals to tell us that things are different, we need to assume that we're in the same price environment that we've been in really for the last decade and continue trading to the long side and continue taking advantage of this price action that is really giving us kind of a gift, really. You don't often get a market that climbs this steadily, and when it happens, you really should take advantage, because when the market trades sideways like it did the last couple of years, it becomes a lot more difficult to extract as much profit as you can from it. Now here's a look at the NASDAQ. We're looking at the Qs, and this one actually is so strong that we don't even really have the rising wedge. And you take a look at that, and that's, again, very strong price action. We're at the top of that trend line, which again is telling us that maybe we're starting to get a little overextended yet again. And there's a decent chance that we're going to have to do the same thing. We're going to have to pull back and test the 20-pair moving average, maybe dip a little bit below it. As you can see, the NASDAQ has been, relatively speaking, stronger than the S&P 500. And as a matter of fact, has been stronger than Dow Jones or the small caps of the Russell 2000 as well. And a lot of this, of course, is due to the fact that the major FANG stocks are all doing very well. They've all picked up a lot of steam as we started the new year, and that has led the NASDAQ into a pretty strong bull market, stronger than maybe what we're seeing across the board. Now, if we do get a pullback, I expect the NASDAQ to hold the strongest of the four major indices, and that means that we're likely to just find a pullback to the 20-pair moving average, and somewhere around here, around 225, 224. We don't really have that same head and shoulder scenario playing out right now on the Qs. Again, showing relative strength. The most recent pullback only came up to maybe half of that prior wedge, and that level of support that would have been the neckline on the S&P 500, it's way down here at 210, and the NASDAQ is nowhere near coming to that level. So this is definitely a point in favor of the bulls and a point in favor of a ascending slope scenario or ascending channel scenario rather than the head and shoulders. So as you can see, we're holding very steady. We've got our moving averages moving parallel to each other higher, the 20 period up here and the 50 down here. And when you have the two moving averages kind of climbing upwards like that, they kind of form these train tracks for the market to just continue chugging along and continue going higher. And until we see a change in these moving averages, we have to assume that the market wants to continue climbing higher. And as I pointed out last week, eventually you get a breach, and when that happens, you'll start to have the price action go in between the 20 and the 50. You'll see that's what we did on the S&P 500. And when you have a strong trending market, that eventually resolves to the upside. And so you see we had the train tracks, right? We pulled back, we tested the 20, we went below, we tested the 50, kind of chopped in between the two, and then resolved right back to the upside and continued climbing upwards. And the train tracks didn't really turn over yet. They continue to climb upwards. So again, indicating that we have a pretty strong trend. And until we see these train tracks cross, when we see the 20 cross the 50, we see price action start to trade below the 50, we have to again assume that we're in a strongly trending market and that we should just continue to ride the train upwards rather than trying to guess when the top of that market is or when that train's going to hit a wall. A lot of traders get bold here and they start to call tops because they see this price action, but the truth is that this price action could persist for a lot longer than a trader can stay relevant or stay capitalized. And so in these situations, we're better off waiting for dips. If for instance, you're just uncomfortable, you think the market's too stretched out, you don't have to short it. You could just wait for a pullback and then buy that pullback, and you just have to trust the support when that pullback comes. And if that's the case, you'll end up making a lot more money than trying to call a short here and being wrong 7 out of 10 days, and then when you finally get it right, you get a 2-day drop and then it bounces right back, and if you weren't real quick about your profits, you end up in a losing trade anyway. So in these scenarios, you're better off trusting the price action and just riding that train upwards until those tracks change. And like I said in the S&P 500 right now, a little minute ago, we'll get warning signs. If the market is going to roll over, it doesn't happen in one day. Sure, sometimes the markets, when you have these market tops or God forbid a crash, yeah, sometimes you get big moves the first day, but really the meat of those major corrections happens a little bit after that, and you almost always have warning signs that they're coming. And I think at the moment we're not getting enough warning signals to get bearish or to worry about where this market is going. Now, I do think if we look at it in the long term, we look at our 10-year market, we're starting to reach a point where we're getting to pretty rarefied air, and there will be a time when the market needs to correct, and it might happen later this year, it might happen next year, might not happen for another 5 years, but when it happens, it'll probably be pretty bad. But if you're trading and you're worried about that, you could be missing out on all the profits to give you a blanket of protection once that market does end up correcting. So if throughout the last year you've been worried about a market correction, well, you've lost a lot of profits that could have been the buffer that you end up losing instead of losing your original capital, right? So if you gain 10, 15, 20% this year, then when the market does correct, at least you have that extra buffer that'll hold you down as you wait for that market to start to correct, and you'll have a little bit more profit to play with as you adjust and start to switch your plays around and start to rein in your risks. So try to make sure that you take advantage of this market, because once it does correct, and sooner or later it will correct, but until it does, you want to make sure you extract as much profit as you can from it. That way, when it does correct, you're in a much stronger position and able to weather it a little bit better. All right, now, as far as the Qs are concerned, I don't think there's that many more levels that we need to point out. We've got a major level of support here down at 210. Other than that, I think the two moving averages are the key level of support. Typically, when you have a strong trend like this, the moving averages are the first levels of support, and then from there you start to develop horizontal levels based off of previous price action. Now, if we go to the Dow Jones, you'll see a little bit of a different picture. The Dow Jones has showed, I think, more weakness, relatively speaking, to the S&P 500 and the NASDAQ, but it's pretty close to what the S&P 500 is doing, right? We've got our move up to about 290, then we came back, we found support at 283, even though we overshot it for a bit, and now we're coming up, and we're trying to make our way upwards, and as you can see, it's very similar to the S&P 500. We've got a little shooting star here. We've got some selling pressure the last couple of days, showing that there's a lot of selling pressure, a lot of supply up here in 293, 294, 295 area. And this one, again, could end up giving us a head and shoulders, depending on the severity of the pullback, once we sort of correct off of the level we're at right now. Now, similar to the other two, you could draw a channel, and we're kind of close to the top of that channel, right? I'm not going to keep that there, but just giving you what happens if we extend it a little bit. So I think, again, we're due for a pullback soon, and the question is, when we pull back, are we going to continue stair-stepping and climbing upwards and just using the 20-period moving average as a launching pad, or are we going to come back and test lower level support? I think as long as we don't come back and test 285, 284, we're in good shape, and it shows that the market is still trying to stair-step and still trying to climb upwards, and is not in a position that we need to worry too strongly about. If we do pull back all the way to 285, well, then we have to see, this should be a very strong level of support, and should be a good buying opportunity, but then we'll have to see how the next bounce occurs, and whether there's enough movement to invalidate that potential head and shoulders that we're starting to see, even though we only got about half done, and not the important half is the second half, of course, but we'll see what ends up happening, whether that becomes a key area. Now, I think the Dow Jones, for the most part, is very similar to the S&P 500. I don't really follow it as closely as the other three, because it tends to just kind of follow them. But basically, if the Dow Jones, basically the S&P 500, whatever it does, the Dow Jones is going to mimic it very closely. So everything I said about the S&P 500 applies to the Dow Jones. We've got a level of support here at 293 that probably won't hold, and it'll probably come down and test the 20-period moving average. And really the key is, can we stay above the 20 and the 50? And if that's the case, I think, again, it shows a market that wants to continue forming a channel and stair-stepping upwards. If we lose the 50, I think that's when we start to worry about where we're going to head down. And at that point, that's when we need to start reassessing where we stand in the market and what kind of emergency plan we want to have in place in case the next bounce is short and we do get something that starts to approach what a head and shoulders looks like. But again, that's probably 2 or 3 weeks away. And as that comes through, we'll start to evaluate a little bit more closely and see what happens. Now, the last index we want to look at is the Russell 2000, and this one is maybe the most different one. Well, obviously the most different one. We're nowhere near all-time highs. As you can see on the weekly chart, all-time highs are actually still quite a bit of ways. You can see the all-time highs here are somewhere in the 173, 174 area. And right now we are down here around 167, 168. So still a little bit of trouble. Also, relatively speaking, you can see the weakness. When we did pull back, we've sliced right through this level of support around 163, 164. So it shows that we're still worried about risk in this market. If you take a look at what the IWM, what the Russell 2000 represents, it represents appetite for risk. It represents traders taking advantage of volatility and trying to get as much return as they can off of the most volatile assets, which tend to be the small caps. And the fact that they are underperforming shows once again that traders are still running away from risk rather than embracing it. And until we see a change in that, it's the one real bugaboo I have, and it's I think the one real weakness in this market. And I think that's what's really holding us back from that steady climb that we saw in 2017 or that we saw in 2012, 2013, 2014, is that the small caps still aren't quite in the same place as they were back then. So we still need to catch up here. Now the good thing is we did hold up. We still have our moving averages. Now again, you can see the train tracks in this case are not quite the same as the other indices, right? You see how close they got and are possibly still in the process of trying to cross over, depending on how we hold and how we bounce over the next couple of days. But in this case, you can see IWM it's already trading sideways. It's not climbing like the other three indices. And typically, you would look at that and say, well, this is a warning sign, and it's probably telling us that the rest of the markets are going to start trading sideways and maybe even roll over. But the one thing I would say about that is that IWM has been relatively weak for 4 or 5 years now, and the markets have still kind of chugged along and held up pretty well. So, this is still our first warning sign. If IWM does a full rollover and heads back down below 164 into the 162, 161 area, then I think that will bode poorly for the other indices, and we'll have to go back and see what they do. But if IWM continues to trade sideways, I don't think it's necessarily the end of the world for the other three indices, because the other three indices, for the most part, have been pulling IWM along little by little over the last really 4 or 5 years anyway, and they'll probably continue to do so. However, I think this is our first warning sign, and so if you're really worried about this market, the first place you want to look at is IWM and see what they do and see how they perform. We do have that rising wedge that we're seeing across the board. It does present itself here as well. It's not quite as stretched out, but we do have a bit of a rising wedge starting to develop on IWM as well. And again, it shows you just the fact that the sellers do have more control of the price action on the small caps, because again, it's not nearly as stretched out as what we're seeing across the board. So it shows that there is a lot of impact here between the buyers and the sellers, that the sellers are impacting the price action and are maybe not controlling it, but definitely putting up a fight, as opposed to what we're seeing on the other three indices where they're really struggling to maintain any kind of a foothold whatsoever. And really, as far as what we're seeing here, we want to see us hold above 164. That's their 163.80, 164. That's the key level. Above that, it would be nice if IWM kind of held above this 165, 166 area and stayed above the 20 and the 50 and made its way back upwards. I think that would be a pretty positive sign, and it would just show that it needed more time to correct, but it still corrected and was able to continue pushing upwards, rather than this turning into a bunch of slop where it really can continue upwards. It looks like, and so basically what I'm saying is, if you look at the S&P 500, we had this move up, and then we had a correction, and we moved right back up, right? With IWM, we had to move up, and then we're still in the correction. We're starting to move upwards, but we're still technically in that correction. We haven't been able to print a new high. We haven't really been able to move past the range that we spent most of the last, really all of 2020 in. And so IWM, for the most part, is still in a correction from that strong move we had to close out 2019 and even to start 2020, and IWM for the most part has just been stuck trading sideways. So it's still in the process of retracing that previous move and correcting, and really trying to find new buyers to support it upwards. And so it really in a different place altogether from the other three indices. Now, when we look at this all together as an aggregate, I think it still shows a strong market. It shows a market that is trying to go upwards but has weak spots. As you can see, there are chinks in the armor. There are little areas of the market that are not performing as strongly as what you would expect out of the overall market. Because of that, I think that we're still in a market that is more inclined to stair-step rather than that strong channel that I'm hoping for and that I hope we get. And I think in order to get that strong channel, we need IWM to start participating a little bit more healthily, and start to make its way upwards and start trying to find its way back to its all-time highs. If we don't see that, then I suspect that the other indices are going to start trading more sideways and maybe even threaten those head and shoulders that I pointed out as possibly happening. And so that's where we stand. Now, as far as trading process and how we want to go ahead and trade during this environment, I think it's very similar to what we did last week, which is really you need to be a little bit more careful about what you're picking, and make sure more than anything that you're looking for good risk reward. It's easy to get caught up in chasing the price action when you have a market that's doing basically what the NASDAQ is doing. When you see a market like this, you have the two major fears in the market, right? You have the fear of loss and you have the fear of missing out. And I think that a lot of times the fear of missing out is the one that really gets traders in trouble. And that's what this kind of market does. When you see what the NASDAQ is doing, you get a lot of traders that really struggle to remain disciplined because they feel like they're missing out on potential gains, and they jump in way too late on a move, and then they're the ones that get caught in these retracements, and then end up stopping out, and it's because they didn't have the discipline to wait for the proper setup. So the key right now is to remain bullish, but to make sure that you're disciplined in how you're looking for your trades and making sure you find trades that are presenting good risk reward. Even if they're names that are lagging behind the market, you still rather trust the risk reward over relative strength in this particular case. And you want to make sure that you are, not necessarily bottom fishing and looking for names that are in bear trends, but looking for names that are in healthy consolidations and have found their way back to support. It doesn't have to be major support. It could be a moving average. It could be just a short-term correction. But you don't want to trade stuff that's at highs with a long way to go before it hits any kind of real relevant level of support. All right, so that's the four major markets. Let's take a quick look at the U.S. dollar, and then we'll move on to the chart requests. If anyone in here has a chart request besides Ray, I know we've got a few viewers in here today. If you have a chart you want me to look at, it doesn't have to be a name that you're holding or a name you want to buy. It could just be something you have a question on, or it could be something that you bought and you're trying to figure out whether you want to take profits, stop out, anything of that nature. If you want to get my read on your chart, just go ahead and type it into the chat. I'd love to see what you guys are looking at. Particularly in this market where it's been a little bit trickier, I think, to find swing trading names. Keep in mind also, we are still towards the end of the earnings season, and when you look at names, you should always pay attention to when the earnings report is going to happen, because that could introduce extra volatility that you're not really ready for. All right, so here's a quick look at the U.S. dollar. Also, if anyone here is interested in Forex, let me know. I always go over the U.S. crosses, but I feel like not a lot of the viewers are into this. But I feel like if you know technical analysis well, you should be able to trade any instrument. And I feel like a lot of times the U.S. dollar crosses give you pretty good, or Forex in general gives you pretty good trends that are easy to follow. So here's the U.S. dollar showing strength yet again, making its way up to a pretty critical level here. And I think overall really acting a little bit better than we probably expected. After this big drop, I expected the U.S. dollar to really just kind of trade sideways and try to establish a bottom. And it's done a really good job of reclaiming almost that entire gap. You can see it's really close to a gap fill here. Now, if we look at the Euro-US dollar cross, we'll see that the Euro actually had a pretty big breakdown versus the US dollar. As soon as this chart shows up. Oh, maybe if I type it correctly. What is going? There we go. All right, so in this case, keep in mind this is based off the euros, so down is good for the US dollar and up is good for the euro. And as you can see, the euro is printing new lows and has really broken down. So this is exceedingly well. This is exceedingly good for the U.S. dollar, right? Because you can see the euro has been in a pretty steady downtrend, and it is right now at the very edge of rolling over and basically getting a new leg down on this downtrend. And I thought it did a good job of establishing a base and looked like it had bottomed out. And there's a chance that this is still the very edge of that bottom, and it still tries to bottom out and form that base. But this is right on the edge of breaking down and starting a new downtrend and heading even further down, very close to on its way back down to parity possibly. And this, of course, has been one of the major sources of strength for the U.S. dollar as an aggregate. And if the euro continues dropping down, that's going to continue giving the U.S. dollar more strength. Now, I do expect, even if the euro is going to make a new leg down in that big downtrend, I do expect a reactionary bounce here as it tries to stabilize, even if it's just one last dead cat bounce, and try to make its way up. But overall, right now, again, it's not looking good for the euro versus the U.S. dollar. Now, if we look at the U.S. dollar versus the Canadian, you can see that it actually had a very strong bounce as well, but it did find some resistance, and it started to pull back over the last couple of days. So it looks like maybe it made its way to the top of the range, and now needs to start pulling back. And whether it makes its way all the way back to the bottom of the range, or whether it just comes down and retests the 200 and then tries to make its way back up, is still up for debate. I suspect that it's going to make one more attempt at 133 before we really see what the next step is. And considering the strength that we're seeing on the U.S. dollar versus the euro, we might see it also versus the Canadian. But as you can see, we have reverse course here, and the U.S. dollar is starting to pull back a little bit here. And there's a possibility the U.S. dollar pulls back versus the euro, just because of the euro is starting to get a little overextended to the downside. Now, if we look at the U.S. yen, we see a little bit of a different picture. The U.S. dollar is gaining strength still, and still trying to make its way upwards. This chart has been pretty sloppy. We went over this last week, where we had a beautiful inverse head and shoulders that was supposed to lead to a really strong rally, and instead it led to this broadening price action, showing a lot of disagreement between bulls and bears as to where this should go next. As we mentioned last week, what we want to see now is we want to see this reverse, and we want to see the volatility start to contract. And we're starting to see a little bit of that, particularly on the downside, but maybe even to the upside. And if that's the case, it could lead to a clearer consolidation and then another move upwards. But overall, we're seeing a U.S. dollar that has been pretty healthy over the last couple of weeks. And while it's starting to head up into resistance, I think overall it's still been pretty bullish. Now, if we move on to gold and silver, we'll see that because the U.S. dollar has shown some strength, gold and silver have been sort of struggling. Gold started to bounce last week, but as you can see, it's still stuck in a range, and it's still stuck trading sideways. And I don't see that changing until we see more bearish moves across the board for the U.S. dollar. So until we see the euro really ramp up and start to gain versus the U.S. dollar, or if we see the market really start to head down, we're not going to see gold pick up strength. And I think that's really the key right now, is that there's so much pressure being put on it by the U.S. dollar that it's starting to struggle to move. Now, the silver's at support. Gold is still kind of in the middle of its range. And until we see the U.S. dollar roll over, we're not going to really see these things move again. Now, it could happen, of course. Like I said, the U.S. dollar is approaching resistance across the board. And so if the U.S. dollar does start to retrace, we could see gold and silver at least make their way back up to the top of their range and start to at least maintain that sideways price action until we wait for a more significant move out of the U.S. dollar. But that's really where we're stuck with that. For anyone here that's a gold trader or likes to trade the gold miners, that's the one issue we're having right now. It's a really strong U.S. dollar. And then finally, the last commodity we want to look at is oil. And judging by what we saw, the U.S.-Canadian cross, we should know that oil was starting to pick up a little bit of a bounce. This chart trades with a pretty decent inverse correlation to the U.S.-Canadian cross. And, oil needs to bounce here, obviously. Oil's been in a really ugly downtrend, and it's really struggled. And it's come down to the $50 area, $50 a barrel, which is pretty important. and it's found a decent level of support here, a lot of volatility, and there's a chance that it found a short-term bottom and can at least bounce and retrace some of this massive drop that it's had over basically the start of this year. So over 1.5 months now, and it's gone all the way from 66 all the way down to 49. So it needs to bounce here. I suspect it will bounce and make its way back to maybe 52, 53. I don't see it really getting past this area around 53, 54, and certainly not 55. I would consider this to be a pretty stiff wall of resistance. And for the moment, if it could just make its way up to there, then at least it's stabilized and can start trading sideways. A lot of oil names have been hit pretty hard along with this. And if you're looking for an area of the market that's been beat down and is looking to maybe bounce, that's an area to look at. But I think it's been too weak, and I don't think that when you have a move this massive, it takes a while for it to turn around and come back in the other direction. So I suspect that even when we get a bounce out of this and oil-related names, that we're still going to, it's still not going to be an easy trade because there's going to be a lot of selling either from underwater bulls or from shorters that's going to come in as this thing starts to bounce. And I think we're going to see the same thing in oil-related names. So not an area that I'm that excited about, but I do think that there's a potential for a bottom. And so there is a chance for those of you that like to trade the extreme value, there might be a chance for you in some of these oil names. All right, so that's oil, gold, silver, the US dollar, all the Forex crosses. We'll move on to chart requests now. Like I said again, if anyone in here, we have a decent amount of viewers. If you guys are interested in me looking at your chart, please type it into the chat. I'd love to see what you guys are looking at. All right, so Ray, I'm not sure if you're back or not, but we're going to go ahead and take a look at your names. The first one you're looking at is UNG, and what I'll tell you on this is don't bother. I hope you're not in this. I feel like natural gas is a losing trade, and I feel like it's always been that way. If you take a look at a weekly chart, I think this index suffers a lot from, I think, contango. It's just a broken instrument. If you take a look at this, it's reverse split a bunch of times. It just always drops. So unless you're looking to short this, I would not recommend trading this. Anyone here, this is one of those instruments that you just don't want to trade to the long side. Yeah, you could catch a bounce, but what's the point of trying to catch a bounce in an instrument that always goes down? You're just, it's not the right way to trade. This is the kind of thing, if you could find shares to borrow and short, just short it. Maybe not now, but when it bounces, right? The next time you see a bounce on this. So this is the opposite of what I was saying with the market, right? Where I was saying with the market, where if you think that the market's going to drop, you should just wait and pull it and buy the pullbacks. When you see an instrument like this and you think it's going to bounce, let it bounce and then just short the bounce. You don't want to try to trade this to the long side. It's just you're putting everything. You're just fighting too much. There's just too many variables that are against you before this thing could really help you out. It has not. There are bounces here. This went from 19 to 23. It bounced again from 19 to maybe 23, 22. And those seem like nice bounces, but think about it. You could have shorted it from 22 all the way to 14. You could have shorted it from 23 all the way back down to 19 with a much easier, much quicker move. It's just, even back here, you could have just shortened it from 17 to 14. There's a lot more potential for the downside on this rather than trying to trade it to the upside. So, Ray, I hope you're not in this long. If you're in this long, please don't hold this. This will be this will be a never-ending headache for you if you're trying to hold this. Especially, I know the propensity you have to not want to get out until you're even or up on this. Please don't trade this. All right, let's take a look at ONTX, Onconova Therapeutics. All right, now this one, another one. So as you can see, Ray has been bottom fishing, looking for names that are really depressed in value. Well, Ray, I don't like that the UNG trade at all. Okay, I don't care if it's 30 shares, if it's one share. It's a broken instrument, and it only goes down. Even if you get a bounce, you're really playing with fire with it. Okay. Now this case, this is another name just dropping like crazy. If you take a look at this, look at the long term Look at the long-term chart on this. It's atrocious. Okay, so you're playing basically. This is something that just never goes up, right? Now, the one thing that I will say about this that's a little bit better is that there has been a lot of volume coming in recently on this. Okay, showing maybe there's a change in character here, uh, but when you see the long-term history of these stocks, um, this is a biotech. I don't know if it's reverse split or what it's done, how it's dropped from from that high up to this. But I do. The one thing that's positive is it is getting a lot of volume, showing that whether it's because it reverse split and it just got a lot of volume because of that, or whether it's because someone came in and started accumulating, there has been an uptick in volume. So this one maybe is not as ugly as UNG. I'm still not that excited about this as well because again, just look at that. Just look at this mess. So what are the chances that it all of a sudden miraculously turned around and you caught it at the one exact moment where it hit a bottom, as opposed to the stock that's been dropping for a decade, right? So chances are this thing is going to roll right back over and it's going to head to new lows like it's done every time. But that being said, it's a 50-cent stock right now and it has a lot of volume coming in, and there's a chance that you could double your money pretty quickly or pretty easily. So I'm okay with you taking a gamble on this and see what it does. You can see that it has been making its way upwards. So there is a pattern here. I don't think it's that trustworthy yet, but there is a pattern. You can see that it does. It has struggled quite a bit as it's made its way to the 55.65. You can see, so the first time it came down, it was rejected swiftly, right? It went in one day from 55 cents all the way down to 17 cents. So it broke, it lost a lot of value that day, right? It came up, and again, a lot of selling pressure, and it came down, came up, and again yesterday, a lot of selling pressure. Now it has rebounded today, and if it can get back through 55 to 60, then it can make its way up to $1, and you could double your money, right? So there is potential for this one, but this is another one. Don't get too excited about it in the long term, because this name has not been able to prove anything for a long, long time. And unless you know something fundamentally that changes the view of this stock or changes its outlook very, very drastically, then you have to assume it's the same thing, that it's the same mess that it's been for the last how long has this thing been like this? So 2014, right? So 6 years. In 6 years, it's been basically a straight downtrend. So, try to catch the bounce. Be very aggressive with stopping out if this thing goes against you. Well, Ray, here's the thing. You like looking for quick moves, but then you hold on when they don't come. So just make sure that when you're looking for a quick move, if you don't get it, make sure you're aggressive about exiting the trade as well. All right, and the last one we want to look at is MX. Actually, you want to look at yours. So it's going to be, I'm assuming you're looking at this one, the Canadian one, right? Methanex? Because you want MX.TO. Alright, so we're going to look at this one on the weekly chart as well. By the way, if anyone else that has a chart request, I hope I didn't scare you away by my negative attitude towards Ray's recommendations or Ray's stock picks. I'm going to be honest. I'll be honest with anything I say. So, I'm not gonna try to sugarcoat it and just give you. If I don't like the stock, I'll say I don't like it. But that's still there's value in that. Last week Ray had very good stock requests or stock picks, and they looked really good, and I liked them quite a bit. Not a fan of his so far today. Now I know, Ray, I'm not sure. Thank you, Colorado Berry, for saying something. I know sometimes people are in here, Ray, and they either don't have a chat or they don't have a stock they want to mention, or they're just kind of they're kind of shy and don't want to say anything. Um, but I appreciate any interaction I get. It's hard to fill up this hour. I'm normally not a very talkative person, so it's a lot for me to fill up an hour of talking without seeing some some stocks or some stuff that you guys are looking at. All right, so Ray, this is the last one that you mentioned, and let me know if this is correct. You wanted the Canadian one, Methanex, right? Um, and not quite that. I'm not that excited about this one either. Now, this one's not as bad. At least this is a stock that goes up and down, right? So this one has had moments of strength. So I like this better than the other two as far as that's concerned. It has been in a pretty strong downturn or downtrend, and I mean I think it's trying to bottom here. But honestly, Ray, I don't like this one either, and I'll tell you why. It is at support, sort of, but if you take a look at what this thing has done, this is a perfect example of what it's done, right? So if you look at it, this was not bad right here. It was in a downtrend, and then all of a sudden it formed a nice base, and it was slowly making its way upwards, right? Tried to get back above. You can see that this 53 area is pretty important, right? Tried to hold above 300, so we had a nice, really cup and handle too, or basically a cup and handle pattern, or even a larger kind of almost a cup and handle pattern, as it tried to make its way above 53, and then the handle failed, and it came right back down, and it still maintained the upwards bias as it started to just make its way upwards. So you can see that there was a shift in direction, right? There was a downtrend, and we had the beginnings of an uptrend. You can see in the short term, it was making its way upwards and climbing and trying to get above 53. Unfortunately, it failed to get above it once, then it failed the second time to hold above it, and then it didn't reach it, and then this last time it tried again to get there and failed, and then that's when we got this, right? And so what we're seeing now is a break of this short-term uptrend, and it's come right back down to the bottom. And while there's the possibility that this bottom still holds and it makes its way back up to 54, I don't think that this is what you want as far as an entry signal or a way to enter a stock. Because at this point, you've got all the moving averages. They've curled right back down. And this is the opposite of we mentioned when we were going over the markets. Those train tracks, they're going down, right? And when we had them cross, they're starting to roll right back down and head lower, showing that this is starting to make its way down again. You can see the bounce. It didn't even make it back up to this level, which is the breakdown point, and it came right back. So I think there's enough signs of selling here on a stock that's in a steady downtrend that I would not want to enter long here. I think if I wanted to enter long, you would need two things to happen. One, it'd have to make its way all the way up to up here, at which point you'd have to wait for it to bounce and then really just establish a bottom. So we'd want to see a break above 54. And you would say, well, yeah, but that's terrible risk reward. The stop's all the way down here. Well, no. In this case, what we'd want is we'd want it to, and this is a long way to go, but we'd want it to be above this base. We want it to come up, hold, and then come back, retest, and then make its way up. At that point, we know that it has conclusively established a bottom and is no longer stuck in a downtrend. Now, that's a long ways away, and that might not be the style of trader that a lot of people are. So if they're trying to catch a bottom here, you're already too far away. One, we had the bounce, we came back and we bounced again, and I think if you look at it from here, you might be thinking, well, the risk reward's good, but really the risk reward's pretty poor here because you've got to stop here around 41.50 or so. Let's just say 41 for even numbers' sake, right? And really, you can't go long until it gets above 46, or basically 47. That's a 6-point stop, and you have resistance up here 3 points away, and then maybe 6 points away. So almost 1-to-1 if you're making your way back up to 53 with a stop down here at 41. And really, you're going to find a lot of resistance up here at 49. So if you wanted to catch the bottom of that range and you think that this is still a base that's going to hold, you'd want to be trading a lot closer to 42, but you'd still want you'd still want a pattern of consolidation that gives you a clear entry signal. So you'd still want for this to play out, and then you'd get an entry a lot closer to 42. Even then, I wouldn't be that excited about it because you still have so much overhead resistance and you're so close to rolling over. But that would be what you'd have to wait for. And I think in both scenarios, there are probably better names out there that wouldn't make you jump through so many hoops in order to find a long that provides you with a good opportunity. So, yes, Ray, this is a flag pattern to the downside. It's a little volatile to be a flag pattern, but yeah, basically you have a drop, and then you have the consolidation, and then typically it resumes in the same direction as the previous trend, which would be down. That being said, this is pretty volatile to be a flag, so I wouldn't call it a flag, but that's generally what you're talking about. Yeah. All right, so those are your three stocks, Ray. I kind of like the ones from last week a little bit better, but hopefully, for those of you that are in here, me pointing out what I don't like about a stock is hopefully useful as well, because a lot of times, if you really think about it, when you're looking for trades, I'll go through, typically especially on a Monday, I'll go through anywhere between 600 to 1,000, maybe even 2,000 names, and I quickly scroll through names. I don't really spend a lot of time on them. A lot of times what I do is I have a watch list, and I click, and I just keep going over. And this was raised from last week, by the way, which I did like, and it's holding up well. It's not really resuming that uptrend yet, but it's doing okay. But basically, I just go through this, and more often than not, I find something wrong with a chart. It's very rare that I find a chart that I don't see anything wrong with, and so a lot of times when I go through these, that's what I'm looking for. I'm looking for names I'm looking for good charts and not bad ones. All right, so Colorado Barry, you're asking me, show us one that you like. All right, so this week it hasn't been that great, but this is one of the ones that I was looking at this week, and we'll explain what it's doing and why I liked it, because I think it gives you a good example of what I look for in a chart. So you can see we've got a really tight consolidation. We had a stock that was attempting to break past the short-term downtrend, and you can see the risk-reward here, right? We've got a breakout above about 1550, right? So we've got about $1 stop, and then you've got to move up to about 18, so giving you about 250 of possible return, and then more if it can make its way back up into the 20s. It hasn't really the breakout hasn't been conclusive, and I'm not that excited about how it's behaving right now. But this is an example of the kind of chart that I like to look at. In the past, it's worked out really well for us. We had last year in particular, we had BYND, which did really good for us. And again, you can see what I was looking for was that type pattern. And then we had that big move, and we had it with SHAK as well, where again you had the tight consolidation and then you had the big move past it. And so a lot of times that's what I'm looking for. Now, I don't necessarily always look for these, I don't necessarily always look for stuff at the bottom. More often than not, it's going to be something like PRVB, where I'm looking for a stock that is in an uptrend and has just consolidated and is giving us a good entry point and also a clear entry point. I think that's one of the things that I'm really big about, is I want to make sure that when I get a stock, I want very clear triggers as far as entering and exiting, so that there's not a lot of emotion involved in my decision-making process. Another one that we had spent, and this is actually one that's been good to me twice now, is Starbucks, which was good as a swing trade and good as an earnings trade. I had traded Starbucks back here, and it gave me a very clear entry point and had a very nice long trend for us. And then I recently traded it as an earnings trade, where I wanted it to stay in between these two dotted lines, and it ended up doing pretty well for us with that as well. And so, generally speaking, that's what I look for. Now, not to kind of point out only the winning trades, this is one that I've traded twice now, and it hasn't really produced for me either time. But again, I want to show, well, it's still working, but not that well. I wanted to show you the types of trades I look for. So what we're looking for in this particular case, I was looking for a name that, again, was pulling back in a very clear manner to a support level. And once it broke that, I would expect it to make its way back up. Now, in this particular case, AXSM did not work, and it ended up stopping me out. However, again, this week I got in with the potential. If you look at it again, the reason I get in, even if it doesn't work, is you have a stock here. It doesn't seem like a lot, but your entry's around 91, 92, right? And you have potential all the way up to 108. So you're looking at, what is that, 16 points of upside, and you've got downside of maybe 3, 4, 5 points depending on where you put your stop in. So those types of trades, when they work, they pay for the one or two other trades that don't work. So this is the kind of trade that I normally look for. More than anything, if you just look at the common points between them, and what you see, what they all have in common is they all have a descending trend line, or at the very least a horizontal trend line that lets me know when I'm supposed to get in. I don't like to guess and buy prematurely. I like to wait for the buyers to step in and prove that they are taking control of a stock. It doesn't always work, as you can see in this case, but I want to see them at least prove that they're able to break the recent downtrend, and I want a clear level of support that I can use as a stop. And then that way I know what my risk and reward is, and hopefully it's positive, and that could give me a better chance of getting into a name. And it's been pretty good, especially over the last 5 or 6 months. We've done very well, and I think over the last 2 months we've really only had like 2 or 3 losing trades, AXSM being one of them. And overall it's done really well for us. So hopefully that gives you a better idea of what I like to look for. Like I said, I would give you more, but I haven't found that many that are giving me the patterns that I particularly like. And so that's why these last couple of weeks I've been focused a little bit more on my earnings trades, which are very different. For earnings, I don't trade directionally. I just trade volatility. Typically, I either sell or buy volatility depending on whether I expect the name to under or outperform the premium that's put into its options prior to its earnings. It's a little bit more complicated, but as far as technical analysis goes, I tend to want names like this that are consolidating in tight ranges, and what I'm looking for is for the range to expand as it breaks through. So hope that helps. Hope that gave you a better idea of what I like to look for. Normally on Wednesdays, I'll typically give, when I go through, I'll typically kind of review what I'm in and how how it's behaving. And if you like these, like I said, I have them all on patreon.com/stockdarts. I'll post it in here. Is where that's like my blog where I typically post stuff. Most of my trade ideas are for subscribers, but it's only like $8, and a lot of times I'll put them to go free after a few days, so that they're not actionable, but at least people could still see them and see what I'm going through and what stocks I like to look at. So you can go through there and go through that, and there's a lot of articles. I've been writing them for a while now. You can see that'll give you a general idea of what kinds of charts I like to look at and what I'm following in the market. Other than that, I think that covers it for today. I want to thank you guys for attending. Thank those of you that participated. I will be out of town next Wednesday, so I will not be back for the next week, but we will be back the week after that. So if anyone has any questions, you can always ask me on Twitter @StockDarts, and even when I'm out of town, I'll still pay attention to my Twitter account. And you can always ask me on there or ask us on our Discord, and I'll be more than happy to help you guys. And I could do chart requests on Twitter as well if it's necessary. For now, it's just a Wednesday thing. It's something I've done for, I don't know, 6 or 7 years now. It wasn't always on Twitch. It used to be on something else. I spend a good portion of my day trading or mentoring other traders or doing other things outside of trading. So I don't have a lot of time to stream every day, so I try to stream at least on Wednesdays. And then if I ever, for some reason, feel like I should stream on a separate day, I do. But right now, Barry, it's basically just a Wednesday thing. Just middle of the week, get a good idea of what the market's doing, and then, just kind of meet every Wednesday to just make sure we understand what kind of price environment we're in. If I started to get more viewers, I would probably start streaming other days. But for now, there's not enough viewers for me to really spend that much time, dedicate that many more days to this. But hopefully we can grow a little bit, and I can start finding more traders to talk to and interact with. All right, well, hope you guys have a good rest of this week, and we'll meet again not next Wednesday, but the Wednesday after that. Okay? Have a good rest of this weekend, guys.